They're now looking at this metal as, hey, look, silver is actually very important. This is not just a line item on a screen that trades in a range that we could trade, peak and valleys. And this is actually a real commodity, and we better pay attention because this commodity is in demand. And with AI coming in, nuclear energy coming in, robotics, and all the fancy electronics that we want to produce, this metal is needed. And with these deficits, we need higher prices to try to close the gap on these deficits. And just going to that point, you would need the current deficit. You would need 10 First Majestics just to fill the current deficit.
Wow.
The metal should trade at the mining ratio. If the miners actually took control of the market the way I say we should be as an industry, we mine 8 to 1. So for every 1 ounce of gold, 8 ounces of silver is being mined worldwide by the mining industry. So divide the current gold price by 8, and that should be the silver price.
Silver is once again attracting global attention, but Keith Neumeyer says the real story isn't today's price. It's the growing gap between rising demand and limited supply. As AI, data centers, electric vehicles, solar power, and advanced manufacturing continue expanding, silver is becoming one of the world's most important strategic metals. Add in ongoing geopolitical uncertainty and investors' renewed interest in hard assets, and the silver market could be entering a very different phase. In this video, we'll break down Keith Neumeyer's latest outlook, his message to gold and silver investors, and why he believes the long-term fundamentals are stronger than many realize. Let's get started.
I don't know about stockpiling, and there's very little data on that to even suggest that I would know those numbers. But what we do know is China doesn't export silver, and we also know that they're the largest EV manufacturer on the planet. We also know that most of the electronics that we buy, iPhones, computers, microwave ovens, refrigerators, you name it, all the electronic gadgets that we rely on pretty well get manufactured in China. And so they need to have the silver, and that's why the Shanghai premiums are so high, because they need those ounces for their manufacturing sector. What happened in November, December, January, that's what happens. And, a lot of you look at the COT report, or you look at some of the stuff that, the work that GATA does, for example. There was huge short positions, a year ago in silver. And there's different numbers floating around, as high as 800 million ounces of short sales. And they couldn't, there has to be a physical backing to that position, but there wasn't. But they didn't care previously because they just trade the paper markets. They actually don't even need the physical because they'll just go and buy the paper back. They just trade the paper. But in this particular situation, when there's a run on the metal itself, they actually had to find the metal because they couldn't buy the paper because they were losing billions of dollars as it was. So the system, as I said, was on the verge of breaking down, and I'd love to see it again. I think we will. Yeah. But this time around, the short position doesn't exist to that same degree. So, we do see some manipulation going on. They're trying to knock it down as much as they can to, load back up again for the next big rally, which is a little bit different because normally they'd be on the short side. I think now they're getting on the long side. Well, you'd have to dissolve the paper markets. And, the paper markets are so easy for the miners because, we and also from a corporate governance perspective or know your client perspective, we have auditors and we have to follow rules. And, if we sell our metal to the Bank of Montreal or whatever, bank we're dealing with, we know the client. We know, it's a legitimate buyer. If we get a phone call out of India or to China saying, hey, we want your silver, we can't even sell it to them because we couldn't do the due diligence that would satisfy our auditors. So, and again, that's why the premium exists the way it does. So, the only fix is we as an industry have to get together, like the uranium industry, for example, and say, hey, we've had enough of this and we're not going to sell for the paper price.
Is that happening? Is there some in the industry talking? Not really.
Not really, no. Because it's so easy. Executive team. They produce 100,000 ounces of gold or silver and then pick up the phone and call a trader in New York and say, I got 100,000 ounces. They got a check in your bank in 2 to 3 days. It's pretty simple. Why have a sales force of 10 people in your back room looking for buyers? So phoning up Sony or phoning up Samsung would say, hey, we got a shipment coming. It's just too much work. So it's not as simple. The current paper system has been in place since the 70s. To unwind that is pretty difficult. But I think on a positive side, they're no longer on the short side as they were before. They're now looking at this metal as, hey, look, silver is actually very important. This is not just a line item on a screen that trades in a range that we could trade, peak and valleys. And this is actually a real commodity, and we better pay attention because this commodity is in demand. And with AI coming in, nuclear energy coming in, robotics, and all the fancy electronics that we want to produce, this metal is needed. And with these deficits, we need higher prices to try to close the gap on these deficits. And just going to that point, you would need the current deficit. You would need 10 First Majestics just to fill the current deficit.
Wow.
Yeah, I know all the historic ratios and so on, but no one talks about the mining ratio. It's a number that I keep coming up time and time again because, I always say, the metal should trade at the mining ratio. If the miners actually took control of the market the way I say we should be as an industry, we mine 8 to 1. So for every 1 ounce of gold, 8 ounces of silver is being mined worldwide by the mining industry. So divide the current gold price by 8, and that should be the silver price.
Keith Neumeyer believes silver is no longer just a precious metal. It's a critical industrial resource. He points out that demand continues to grow from AI infrastructure, robotics, electric vehicles, solar panels, defense technology, and modern electronics, while global mine production has remained relatively flat for years. In his view, this growing imbalance between supply and demand is one of the strongest long-term bullish factors for silver. Although there is no reliable public evidence that China is stockpiling silver, Neumeyer says China's role as the world's largest manufacturing economy makes it one of the biggest consumers of the metal. He also argues that periods of heavy physical buying expose the limits of paper markets, showing that real supply matters when demand accelerates. Another key point is his mining ratio theory. Since miners produce roughly 8 ounces of silver for every ounce of gold, he believes silver deserves a stronger valuation than today's market suggests. His message isn't about chasing short-term price moves. It's about understanding long-term fundamentals. With persistent supply deficits, growing industrial demand, and years of limited new mine production, Neumeyer believes patient investors should focus on the bigger picture rather than daily market volatility. So what does this mean for investors going forward?
It surprised me where it went to so quickly. $121 was, I was looking at my screen at the time, and we were at VRIC together. And fortunately, the company sold some ounces, in some fairly high territories up around the 100+ range. And it was nice, from a cash flow perspective. But, that whole move, the $50 target was pretty important. And, if you look back at time, silver had only seen $35 3 times in our lifetime. And that was kind of one of the barriers. Once it broke through 35, the next was 50. And usually when you see a double top or a triple top, double tops are often fail. Triple tops, if they fail, it's quite negative. But often, if a triple top is breached, you see a parabolic move in anything. It doesn't matter if a commodity or a stock. And that's exactly what we saw. But the thing with the parabolic move is you don't know what the high is, right, where it's going to stop. So everyone starts guessing, right? 85, 95, 100, 105, 110. I saw people saying, 150, 170, and, we're all guessing. But eventually the buying exhaustion does come in, and the buyers just disappear because, there's only so much on the buy side that's possible. So we saw the correction. The correction has surprised me how quickly it happened. But once again, I've talked about this many times throughout my 23 years at First Majestic, it's a paper market. Yeah, and there was a lot of short covering that happened in the high 90s or high 80s right through 100. A lot of people lost a lot of money. A lot of people made a lot of money. But the paper machine has taken over once again, and we see this major correction, about a 50% correction. I think we've seen the lows, quite honestly. But we need to bounce around. The market, the investors, institutional investors need to get used to this kind of new pricing regime that we're in. And it may take 6 months. It may take 12 months. Who knows? But, blow off top would suggest that, everyone is selling. And I didn't sell, so a lot of the people at this conference, maybe some took profits. Who knows? I hope there were people that took some profits on First Majestic. The stock went to over $40 a share, which is pretty obviously significant. I think our market cap exceeded 10 billion. I think it actually got much higher than that because today we're at 9. So yeah, we got almost a $20 billion market cap in a very, very short period of time. Blow-offs, I don't know. It's blow-offs tend to last longer. Like Nvidia, I would say, that would be more likely. But
$1 trillion sell-off on Nvidia. I'm wondering if it's going to start seeing some of that general capital come over to the metals.
yeah, we hope so. That's what happened in 2000, right? When the dot-com bubble burst, the Nasdaq hit a record high in March of 2000, and over the next 2 to 3 years, it corrected 80%. And then, that was the beginning of a 10-year bull market in the mining sector. So, that's what I've said this market looks like, but it doesn't happen overnight. You got to, test these, you test the market, come back, test the market, come back. And, that 10-year bull market from 2002, call it, to 2012, there was many times throughout that 10-year period where we had major, major corrections. And I think that's what we're seeing right now. Yeah. Well, there is above ground supplies that have to come into the market. I think that's what's been happening. But, the supply demand fundamentals for the metal has not changed today. Or was it any different when silver was trading $120? The demand is still there. The miners can't produce any more metal, and the industry's proven that. We've had 10 years of flat production from the miners at about 830 to 850 million ounces per year. That hasn't changed. You would think, like, if you're manufacturing Levi's or gadgets of whatever, and all of a sudden you could sell your gadgets for twice what you could sell them for a year ago, wouldn't you produce twice as many gadgets? But the mining sector doesn't work like that. We're producing exactly the same today as we did virtually 10 years ago. Well, we felt it, and because we were getting phone calls from buyers around the world saying, "Hey, we need some physical right now." Now, fortunately, we have our mint and we have a vault. There's about 500,000 ounces sitting in our vault right now. So, if we get a call from someone that's willing to pay us a substantial premium, which we did during that spike, we gave some silver to a group out of eastern United States. We knew them and we did them a favor, and they gave us a pretty good premium to spot at that time. They had the money in our account within a couple hours of doing that deal over the phone, and we had the ounces in a vault, in a Brinks truck the next morning. So we can act quickly if necessary, but there's and you can tell when there's a physical problem, when the lease rates start to go up, when our margins start to go up, and the traders can't take our metal. They're saying we'll buy it from you, but you're not going to get paid for a month or 2 months, and that type of thing was happening. Fortunately, and we got margin called in December of 2025 as well, and we had a choice of either covering because we were selling into that rally. And we decided just to pay the margin because why would we cover? Because we got a big balance sheet. Our balance sheet, we got over $1 billion in the bank. So why would we be caught in a situation like that? So, and then we just, obviously delivered into those sales, into the first quarter of this year.
Keith Neumeyer's message is simple. While short-term prices may remain volatile, long-term value will ultimately depend on physical supply, industrial demand, and the market's growing recognition of silver's strategic importance. Do you agree with Keith Neumeyer? Is silver still undervalued? Or do you think the market has already priced in its future potential? Let us know in the comments below. If you enjoyed this video, please hit like, subscribe to the channel, and turn on the notification bell for more trusted updates on gold, silver, and the global economy. Thanks for watching, and we'll see you in the next video.